Hi, you're welcome to episode 8 of Make It Count Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado. And on our previous episode, we were able to establish the essence of differentiating between the various types of expenditure as well as the types of receipts. And during that session, we were able to tell the differences between capital expenditure and revenue or operating expenditure. So we were able to establish the differences between capital receipts and revenue or operating receipts. On this episode, we'll be looking at the various books of account. Books of account. And this will be the first in our series of recording transactions. By the end of this session, we'll be able to establish the various source documents which will be used to initiate transactions, that's the recording of transactions. Then we'll be able to look at the books of prime entry as well as the principal books of accounts and the various types of books of accounts. So this is going to be our agenda for this episode. If you are ready, let's get into it. You'd recall that when we were defining what accounting is, we said it is a mechanism or system for the initiation, recording, processing and classification, summarizing, and reporting of financial transactions for the purposes of course, communication, analysis, interpretation, as well as supporting decision-making of various users of financial information. So going back to those 5 activities: initiation, recording, processing and classification, summarizing, and reporting. We mentioned that we initiate transactions with source documents. So we initiate transactions with source documents. And then we will record transactions in books of prime entry. We'll record transactions in books of prime entry. And then we will process and classify those transactions recorded in the books of prime entry into the principal books of account or the principal accounts. So today, on this episode, we are going to ascertain what the various source documents are that we'll be using to initiate transactions. Then we'll look at the various types of books of prime entry into which transactions will be recorded. And then we'll look at the principal books of account into which transactions will be processed and classified. So that's basically our agenda for today. Let's start with our source documents. Typically, we'll have source documents coming in 6 forms. The first one has got to do with cash transactions. Cash transactions. And typically, what kind of source document will trigger us recording a cash transaction? Here, we'll be talking about a checkbook, we'll be talking about a receipt, or a bank pay-in slip. All right? So a checkbook, a bank pay-in slip, or a receipt. These will be typically the kinds of source documents that will be used to initiate cash transactions. I hope that is clear. Good. Now, how about sales transactions? When a sale has been made. Typically, the source document which will be used to now record such a transaction will be a sales invoice. A sales invoice. And a sales invoice is typically the document that is issued by you, the company, to your customer, evidencing that you have made a sale to them, establishing the obligation of the customer to you, the one who have provided the service. So a sales invoice will evidence that the company has made a sale to a customer. Now, still in connection with sale, what happens when the customer returns a portion of the goods sold? When there is a return inwards, what document do we use as evidence to initiate the recording of such a transaction? That we call a credit note. A credit note. So what the credit note does is that it passes a credit onto the account of the customer. So for instance, there may have been a sale which was evidenced with a sales invoice to the tune of 10,000 Ghana cedis. And that 10,000 Ghana cedis was as a result of supplying 5 units, each one of them at the cost of 2,000 Ghana cedis. So 5 units of a particular product, each of them at the expense of 2,000 Ghana cedis. Hence, a sales invoice amount of 10,000 Ghana cedis. So these items are supplied to the customer. Then the customer examines the items that they have received, and they realize that 2 of them are defective. There may be a damage or an expiration, the reason for which they would want to return those goods. And so when they return those goods, the customer does not still have the obligation of the entire 5 items, but they have an obligation for only the 3 items that are in good shape. And so those 2, which will be worth 4,000 Ghana cedis, would have to be reduced from the indebtedness of the customer. And so you use the credit note to the tune of 4,000 Ghana cedis to reduce the liability of the customer towards you, which was originally 10,000, to bring it down to what? 6,000. And so that is what a credit note gets to be used for as a source document. I hope that is clear. Good. Now, let's flip it and move to dealing with a supplier. When you are dealing with a supplier, the document you use to evidence a liability to your supplier for the supplier having supplied certain goods to you or services to you is what we would call what? The purchase invoice. So you see, in the case of a sale, it's an invoice. In the case of a purchase, it is still an invoice. Just that in the case of a sale, it is a sales invoice, whereas in the case of a purchase, it is a purchase invoice. And so when a customer, or let's say when a supplier rather, supplies goods to you at a certain value, they will send you an invoice, which will be the evidence for which you record that liability, that purchase from the supplier. So what if you also make returns outward? That is, you examine the goods and you realize that there may be a defect, expiration, obsolescence, or whatever the case may be. And so you need to return a part or the whole of those goods. You're right. You would now use a debit note. You use a debit note. So here, you owe a certain liability to the supplier, but you are returning a portion of it back. So you use a debit note to record the value, that value that you are returning back to the supplier onto the supplier account or the vendor account to reduce your liability to the supplier. And so that's what the debit note is used for. I hope that is clear. Good. So the final type of source document we'll be looking at is what we call the real or proper journal. A real or proper journal. So what is this one used for? Typically, there are certain adjustments that would have to be made in various accounts which do not have to deal with, let's say, directly a supplier or a customer or does not have cash involved. A typical example is, let's say, you made an accrual. You accrued a certain expense. So for instance, you had accrued an electricity bill, right? You accrued an electricity bill to the tune of 5,000 Ghana cedis for the month of March 2025. And that was because as of the end of March 2025, when you were closing your books, you had not received the bill from ECG, the Electricity Company of Ghana, when it comes to your bill for the month of March. However, you remember, because of the prudence concept, all right, and also accruals, you would have accrued the expense for March based on your bill for the month of February. So you received the bill for February, which was 5,000, and so based on that, you use that to accrue the expense for electricity for the month of March, while you wait for the actual bill for March to come through. Now, you enter into April and ECG sends you your actual bill, which is now to the tune of, let's say, 6,000 Ghana cedis. At this point, what you have to do is you need to reverse the initial amount you accrued, which was 5,000, and then record the actual, which is the 6,000. And so what you typically use is a real or proper journal to reverse the initial one and book the subsequent one, or the actual one. So it is in a situation like this that you require a real or proper journal. And so that becomes the source document for recording transactions like accruals. I hope that is clear. Great. So now we are clear in our minds the various source documents. Now the next question is, into what books of prime entry will we record the transactions from these source documents? So don't forget, for the first activity of initiation, we have been able to determine the various source documents. So now, at the next activity of recording, let's find out the various books of prime entry into which these various source documents will form the basis of we recording transactions. So let's go back to our first source document, which is a check, a cash receipt or check receipt, as well as a bank pay-in slip. It could be a check pay-in slip or a cash pay-in slip. I hope that is clear. Good. So now let's look at the book of prime entry into which transactions in respect of these source documents will be recorded. For a check, bank pay-in slip, or a cash receipt, it will be recorded in what we call the cash book. The cash book. And the cash book is a book of prime entry where all transactions that involve the movement of cash is or are recorded. The cash book. So that becomes the book of prime entry. Now let's move on to the second book of prime entry when it comes to sales invoice. Sales invoice. So we record the transactions in respect of which we have the supporting or the source document sales invoice. That is into what we call the sales day book, the sales day book or the sales journal. The sales day book or the sales journal. So this is a book where all sales transactions are recorded into. All right, so the sales day book or the sales journal. So how about the credit note? So the credit note, you remember what we use it for? To record what? Returns inward. So the credit note forms the basis of recording transactions into the return inwards daybook or journal. The return inwards daybook or journal. I hope that is clear. Good. So whereas sales invoice will go into the sales daybook or sales journal, the credit note will go into the return inwards daybook or return inwards journal. I hope that is clear. Good. Now let's look at purchase invoice. I'm sure by now you already know the answer. So for a purchase invoice, the recording of a transaction in respect of that will be going into what? The purchase daybook or purchase journal. The purchases daybook or purchases journal. How about the debit note? Of course, the debit note will be going into the return outwards or returns outwards daybook or return outwards journal. I hope that is clear. Good. Now let's look at what we call the real or proper journal. The real or proper journal, when it comes to its recording or recording transactions in respect of that, will be going into what we call the general journal. The general journal. The general journal. I hope that is clear. Good. So that is where all of those adjustments, transactions which are adjustment related, will be recorded into, which is the general journal. I hope that is clear. Good. So now that we are clear in our minds what our books of prime entry are, into which the various transactions arising from the various source documents will be recorded, now we are done with recording. Now let's look at processing and classification. And we said processing and classification, we do it into what? The principal books of accounts. The principal books of accounts. So, in the case of the cash transactions which have been recorded in the book of prime entry, which is what? The cash book. What is going to be the principal book of accounts? It is going to be what? Also the cash book. So that is the first lesson for you here when it comes to the relationship between the books of prime entry and the principal books of accounts. In the case of cash transactions, the cash book serves both as a book of prime entry as well as a principal book of accounts. The cash book serves both as a book of prime entry as well as a principal book of accounts. So that is cash transactions. Now let's look at the next one, which is sales. So with a sales invoice, we would have recorded it in its book of prime entry being what? The sales day book or the sales journal. And what is going to be the principal book of account? That is going to be what we call the sales ledger. The sales ledger. All right? And then how about the credit note, which is the source document, the details of which we have recorded in the what? Return outwards daybook or journal. Its principal book of account is also going to be the sales ledger. Why is this the case? Returns inwards has got to do with what? Sales. Returns inwards has got to do with sales. And so the ledger, which will show all the things that would have happened in respect of sales, will be the sales what? Ledger. I hope that is clear. Good. So now let's look at the credit note as a source document, the details of which would have been recorded in the returned inwards or returns inwards daybook or journal. Which principal book of accounts will that be going into? That is going to be also the sales ledger. Why is this the case? You would realize that whether it is a sales invoice or a credit note, they've both got to do with a sale. So to establish the true position of your sales, the ledger which will bring them together, which will be bringing together both your sales day book as well as your returns inwards day book, so that you know the true position of the sale that you would have made will be your sales ledger. And that's how come for both the sales invoice, which would have been recorded in the sales day book or sales journal, as well as the credit notes, the details of which would have been recorded in the returns inwards or day book or return inwards day book or journal, both of them will be recorded in the sales ledger as the principal book of accounts. I hope that is clear. I hope that is clear. Good. Now, let's look at the purchase invoice. The purchase invoice would have been recorded in the book of prime entry, which is the purchases day book or purchases journal. Good. So now its principal book of accounts is what? Exactly. The purchases what? Ledger. The purchases ledger. All right. And we'll be dealing into much detail when it comes to these issues of ledgers. All right. So if that is the case, then for debit notes, which would have been initially recorded in the what? Purchases day book or purchases journal, what will be the principal book of accounts? That will also be the what? Purchases what? Ledger. The purchases ledger. So now let's look at the debit note. The debit note would have been recorded in its prime book or book of prime entry, which is what? Returns outwards day book. Returns outward day book or journal. When it comes to its principal book of accounts, that is going to also be what? The purchases ledger. So that we can net off all our purchases invoices against our debit notes. So we'll actually net off all the debit notes against our what? Purchase invoice to know what our true liability to our suppliers or vendors, what it actually is. All right. And so that will also go into the purchases ledger. And then finally, the real or proper journal, which would have been recorded in the general journal, the general journal or journal proper. That will now go into its principal book of accounts, known as the general ledger or the nominal ledger. The general ledger or the nominal ledger. And we'll be dealing with these various ledgers in the next item that we'll be looking at. And that is what we call the various classifications of books of accounts, which is our various books of accounts, which is our principal books of accounts. So for the various classes of accounts, primarily there are two classes of accounts. The first, personal accounts. The second, impersonal accounts. The first, personal accounts. The second, impersonal accounts. Now let's look at the personal accounts. Typically, the personal accounts are those accounts which have got to do with identifiable relations. So identifiable relations. So as a business, when it comes to our core business operations, when we produce goods, we'll sell them to our customers. And for us to be able to produce goods, we'll require goods purchased from our suppliers. And so typically, our suppliers and customers are identifiable persons or entities. And that's why they are personalized accounts. Personal or personalized accounts. And so, as you may have figured out by now, typically the two types of accounts that will sit under personal or personalized accounts are our customer accounts, which we would call debtors accounts, and our suppliers account, which we would call our creditors accounts. I hope that is clear. So we have the debtors account and the creditors account sitting under personal or personalized accounts. And so, of course, if we are talking about debtors accounts, what kind of ledger will that be flowing into? Definitely, it's through sales that we build customers. And so we have debtors. So, of course, the debtors account will be sitting in the sales ledger. The debtors account will be sitting in the sales ledger. And then, of course, the creditors account will be sitting in the purchases ledger. The creditors account in the purchases ledger. I hope that is clear. Good. So on the personalized or personal account, we flow down through creditors account, which sits in the sales ledger, and then we flow down through, on the right side, through the creditors account, which sits in the purchases ledger. Good. Now let's look at the impersonal or impersonalized account. So as the name suggests, this or these accounts typically do not have to do with any personal relations or primary parties that we are dealing with. So for this, we will typically have those we call the real accounts and the nominal accounts. The real accounts and the nominal accounts. Why these names? So the real accounts are typically used for recording or processing transactions that have got to do with actual property. So property. So property, typically you would find all kinds of property like property, plant and equipment, PP, fixed assets, intangible accounts or intangible assets, investment property, inventory. You see, these are assets accounts which are property. You get it? So they've not got to do with something like debtors or receivables. That one will sit under a personal account, all right? So this one, these are those that are not identifiable with persons, but with items or properties. And that's why we call them the real accounts. So these ones will flow down into what we call general or nominal ledger. The general or nominal ledger. I hope that is clear. Good. Now let's look at the other side of it, the second leg of the impersonal accounts. So the second leg of the impersonal accounts are what we call the nominal accounts. The nominal accounts. Why do we call them nominal accounts? Because they've typically got to do with flow. And nominal, previously we've mentioned, whenever you hear nominal, has got to do with the money terms of things. So the nominal value of an item. So here typically the kind of account you find are things like revenue, expenses, and the capital accounts. The revenue, expenses, and the capital accounts. So these will be the typical kind of account you'll find when it comes to nominal accounts. And those will also flow into the general or nominal ledger. The general or nominal ledger. So you can see the table where we start from accounts as the general, and we have them classified broadly under two headings, which is personal and impersonal accounts. And under personal accounts, we will typically have what? The debtors account and the creditors account. The debtors account flowing down into the sales ledger, and the creditor's account flowing down into the purchases ledger. On the other side, which is the impersonal account, we would have what? The real account and the nominal account. And the real account, we said, will typically deal with actual property, items like fixed assets, like intangible assets, like inventory, those kind of items. And they flow into the general or nominal ledger. And on the other side, we have the nominal what? Account. And there you'd have something like revenue, expenses, or capital. And those will flow into also the general or nominal ledger. And so, as far as our first 3 steps, when it comes to the 5 activities, when it comes to accounting are concerned, we've been able to deal with all of those 3 in this particular episode. Initiation, recording, and processing and classification. I hope this episode has been beneficial to you. Good. To the next episode, where we'll be looking at the mechanism by which we actually process transactions into the various books or principal books of account. We call it the double entry system. And that is the next thing we'll be looking at in terms of the next episode. But just by way of recap, today we've been able to establish how transactions are initiated, the various books of prime entry into which they are recorded, and the various principal books of account into which they are processed. This has been episode 8 of Make It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado. Let's meet on the next one.